In this video, I'm going to talk about how a company would account for stock options that it grants to its employees. First, I'm going to give you a brief overview of how a company would account for options, and then we'll dive into a more comprehensive example. So on the grant date, that's the date that the company actually grants the stock options to the employee, there's not going to be a journal entry. Instead, what the company needs to do is use an options pricing model to estimate the fair value of those options. And then what the company is going to do is it's going to expense the fair value of the options over what's called the restriction period. The restriction period is the time period over which the options vest. Okay, remember that the employee can't use the options, they can't exercise them to purchase stock at the strike price until the options have vested. So let's say it's a 3-year restriction period, then the company would expense the fair value of the options over that 3-year restriction period. Now, when the options are exercised, the company needs to record the cash received. Because remember, when the options are exercised, the employee is going to have to pay the strike price to the company to buy shares. Now, when the options expire, let's assume that the employee did not exercise them and the options expire unused, then the company would also need to make a journal entry in that scenario to reclassify equity from one account to another. So I'm going to go over all of these. Let's jump into an example with some specific numbers. So WFS Industries, they grant 4,000 stock options, let's say, to their CFO on January 1st, 2024. So that's the grant date, and we're not going to make a journal entry on the grant date. Now, we're going to have here a 2-year vesting period because we got the vesting date is January 1st, 2026. So we've got a 2-year vesting period. Okay. Now, the strike price of the options happens to be $9. That'll come in handy later when we have a scenario where we assume that the CFO exercises the options. The market price on the grant date is $9 a share, so it's set to the same amount as the strike price. The company needs to estimate the fair value of the options on the grant date. Again, they're going to use an options pricing model to do that. Here, I'm just giving it to you and telling you the fair value is $2.50 per option. 4,000 options, $2.50 per option. So the total fair value of the options being granted to the CFO is $10,000 on the grant date. But remember, we're not going to make a journal entry in the grant date. We're going to expense that over the 2-year restriction period. Okay. Now, I'm going to give you the journal entries here. We're going to go through this. But first, I want to say to make things simple, I'm going to ignore tax effects in these journal entries. So I'm just going to have a simple scenario where I say, okay, look, it's $10,000 fair value of the options, 2-year restriction period. So the company's going to debit compensation expense and credit this equity account, paid in capital stock options, and they're going to do that twice, right? Because it's a 2-year restriction period. So at the end of year 1, they make this journal entry. End of year 2, they make that journal entry. And of course, compensation expense is going to reduce the company's profit on its income statement. However, it's a little more complicated than this generally. Okay, now in the United States, when you have what are called non-qualified options, and I'll make another video where I get into like the tax effects of options and incentive stock options, non-qualified options and stuff under U.S. taxes in the future. But for right now, just know that for non-qualified options under U.S. GAAP, we would need to be making a deferred tax asset here because the company would basically be expensing the options for book reporting purposes before they get a deduction for tax purposes. So we'd have a deferred tax asset due to a temporary tax difference. Let's not worry about that here. But just note, if you're an IFRS country, if you're in a country that uses IFRS, you wouldn't create a deferred tax asset until the options are in the money, which means that the market price of the stock exceeds the strike price. So that's a little tax info. We're going to ignore that here. We're just going to focus on the basics. So ignoring taxes, again, as I said, we've got here the 5,000 expense is just the 10,000 fair value of the options divided by the 2-year restriction period, the 2-year vesting period. Okay, so we make that journal entry twice. Now, again, this credit here, this is an equity account. Okay, paid in capital is an equity account. We're going to come back to that account, paid in capital stock options, later. Okay, so if we exercise the options, so what if the employee, the CFO, says, you know what? Okay, now the 2-year restriction period is up. I want to exercise the options. I want to buy shares at the strike price, right? Remember, that's what the option gives them to do. The ability to do is to buy at that strike price, which we had said was $9 a share. Okay, that was the strike price. Now, they've got 4,000 options. So if CFO exercises all of them, that's going to be 4,000 times 9. The company's going to receive $36,000. Okay, so the company is going to need to debit cash, assuming that the CFO exercises the options, for $36,000. And again, that's just the number of the options times the strike price. Now, we're going to debit paid-in capital stock options here. Okay, and why am I debiting this for $10,000? Well, if you look back before, we had credited paid-in capital stock options twice for $5,000. So the balance in that account is $10,000. And what we're going to do is we're going to debit that and say, you know what, that's not related to stock options now because those stock options have been exercised. And so now we're just going to credit the common stock account. Now we're assuming, I'm assuming here that this is no par common stock. I'll make an adjustment in a second where we assume that there's a par value on the common shares. But just so you know, again, the company, when those the options are exercised, the company's getting money. It's getting $36,000. Don't be psyched out, by the way, by the market price here. Don't worry about that. That's not relevant for determining how much money that the company gets. Now, I'm just assuming here that the company is going to satisfy these options by issuing new shares of common stock. So they're going to say, oh, the CFO is exercising these shares. Let's issue some new shares. It could get more complicated if you had a situation where the company already had treasury shares. Maybe, years ago they repurchased some of their shares. They just had them sitting as treasury shares. They hadn't retired them, and then they decide to give those shares. That could happen. I'm not going to get into that here. I'm just assuming the company issues new shares to satisfy the options. So again, company's got to debit cash, strike price times the number of the options exercised. They're going to get rid of the paid-in capital account associated with the stock options, and we're going to credit common stock. Now, just one additional step, if we said, well, what if it's not no par? What if the common stock being issued has a par value of $1? Well, in that case, now we've got the company issuing 4,000 shares times $1 par value per share. So what we're going to have is the common stock in that scenario would get credited for 4,000 instead of the entire 46,000, and the remaining balance to make the debits, because remember the debits got to equal the total credits, right? So we got 46,000 of debits, we need 46,000 of credits. So if we just have a credit of 4,000, we're going to need a credit to additional paid-in capital of 42,000. So basically, additional paid-in capital is the plug. I hope you understand. This is just a hypothetical scenario. If they exercise the options and we had $1 par value, and here this scenario was what if it was no par common stock. But in each case, I'm giving you the journal entry for if the CFO were to exercise all 4,000 of the options. Now, let's do another hypothetical. Let's assume that the options expire unused, that the CFO never exercises them, right? So if we go back to the original fact pattern and said that basically that they had eight years. So like after 8 years, that basically the options are going to be, if they haven't been exercised by then, like they don't get forever to exercise these options. So if after 8 years the options exercise or are not exercised, they expire unexercised, then what's the journal entry? Well, if that's the case, we also need to make a journal entry. But what we're going to do, again, CFO here, we're assuming they are not exercising the options, and we get to January 1st, 2032, and we say, you know what? Now the options have expired. What we need to do is we're going to credit, okay, so we're going to debit. First of all, we're going to get rid of that paid-in capital stock options account. Remember that was the thing we debited or we credited twice for 5,000. Remember we debited compensation expense for 5,000. We credited this account for 5,000. We did that twice, right? Once each year of the restriction period. Now we say, okay, we got to get rid of that account. Okay, it has a balance of 10,000. We got to get rid of that. We're going to reclassify. This is an equity account. We're debiting, and then we're going to credit a different equity account, paid-in capital expired stock options. So all we're really doing is moving it from one equity account to another if the stock options expire unused. Total assets, total liabilities, total equity are unchanged. This journal entry has no effect on the income statement, anything like that. We're simply saying, let's reduce this paid-in capital stock options account because those stock options are no longer around. They're done with, they expired unused. And now what we're going to do is we're going to transfer that. We're going to credit this paid-in capital expired stock options account.